Thank you, Jen. Good afternoon and happy holidays, everyone. My name is Jeremy Stelter. I'm Executive Vice President here at the Stelter Company. Thanks for joining us for our webinar today, Plan Giving Looking Ahead to 2024 and Beyond, presented by our friend Phil Purcell, the Territory Director of Plan Giving for the Central Territory of the Salvation Army. I'll get back to introducing Phil in just a minute, but first I'd like to just say a few words about our webinar series. As an expert advocate for asset-based giving, Stelter is committed to providing innovative solutions and education for the nonprofit industry. We pride ourselves on being a bridge builder for the community and are happy to host this free webinar today, connecting you to experts across the country to assist you in maximizing revenue across your development portfolio. Today's webinar is the 8th and the last one in our webinar series this year. If you missed any of them, you can find all the recordings on our website at stelter.com/webinars. As we plan out this schedule for 2024, we'd love your help. Let us know who you would like to hear from and any topics you would like to learn about in our post-webinar survey following the presentation today. Now back to today's webinar and our presenter, Phil Purcell. Thank you, Jen. Phil has enjoyed a 30-year career in Plan Giving and as a counsel to nonprofits. He currently serves as the Director of Plan Giving for the Central Territory of the Salvation Army. In this role, he is a directional leader of over 30 Plan Giving officers in 11 states who close approximately $70 million in plan gifts each year. He teaches courses on law and philanthropy, nonprofit organization law, and plan giving as adjunct faculty for the Indiana University Maurer School of Law and Indiana University School of Philanthropy. Phil currently serves as on the board of directors, president-elect of the American Council on Charitable Gift Annuities, which I get the pleasure to serve with him. Phil formerly serves on the board of directors for the National Association of Charitable Gift Planners, past secretary, Charitable Gift Planning Group of Indiana, past president, Association of Fundraising Professionals, Phil, Indiana chapter, past president. He's a certified fundraising executive and received the AFP Indiana Fundraiser of the Year. Believe it or not, there's a lot more I can tell you about Phil. He's a legend in this space, and we're just really, truly honored that he's joining us today. So thank you so much, Phil. We're excited to hear what you have to say today.
Thank you so much, Jeremy, for the kind introduction and the opportunity to be with you and everybody on this webinar today. My task, of course, is to look into my crystal ball and peer ahead into 2024 and the years ahead. One thing I've learned, the older I get, the less qualified I feel sometimes to be a Svengali, let's say, or like that. But we all do form our opinions about the directions that things are going, and we observe the trends of the past and can't help but think, what do we need to be doing to be as strategic as possible in our use of dollars and our time and our talents to raise gifts, especially plan gifts, for the benefit of the important organizations you serve. So I'll do my very best to give you a number of ideas. Those of you who have not heard me speak before, my modus operandi is to usually have probably a few more slides than really I can get through. So some slides I'll linger on, some I'll pass over very quickly, but you'll be getting copies of all the slides and you can peruse them in more detail later as you wish. And I am available if you want to shoot me an email afterwards. I put my personal email address here to try to keep this kind of work separate from my day job with the Salvation Army. And also, please excuse me, I'm recovering from a cold, so I may pause a minute here and there if the cold catches up with me a bit. So let's jump in. And I am a baby boomer, proudly must say I'm a baby boomer and a fan of Bob Dylan. I know some are not. But you've asked me to speak, so I'll share some of my preferences. But his song, The Times Are A-Changin', it's a song I think of quite a bit, or have over the years, and especially now as I get older and look backward and forward, not just in the gift planning community, but life at large. But the phrase of gather around people wherever you roam and admit that the waters around you have grown. Things change, times change, circumstances are different, and our strategies, our plan giving strategies, must change with those times to, again, maximize our fundraised dollars. I'll zero in on 4 broad areas today, looking at some issues on the big picture side of things, or what I think of as big picture issues. Some topics relative to building relationships with donors. Thirdly, an important subject of dealing with donor intent and some ramifications of procedures and policies therewith. And then finally, some tips or thoughts around what are powerful philanthropic strategies moving forward into 2024 and beyond. So let's first look at the big picture. One thing I like to say now is that the time is now. By that, I mean that we have this boomer generation, the wealthiest generation in the history of our country, of the world, with, by whatever count you look at, trillions of dollars in wealth, approximately half of all wealth in the United States, and 80% of that wealth in non-cash assets. So this is a very, very important target market for we as fundraisers to think about and strategize in terms of our plan giving solicitations, as many of these boomers are in retirement or starting their retirement years. A very important cohort. And it's actually this phrase, the time is now, in fact, was the catchphrase that I used when asking my organization for additional monies this year and hopefully in future years to help promote plan giving, to convince them of the importance of investing in plan giving now to recoup the benefits down the road. So in any event, the boomer generation, very important, but it's not just the boomer generation. Prior to the boomers were the silent generation. They have significant wealth still, about $50 trillion. Those are the folks born between 1925 and 45. Then we have Gen X and the millennials following. This isn't necessarily a seminar on the distinct, interesting generational differences in giving and thinking, but I will make reference to some of this a bit. But the time is now to maximize results. So investing in plan giving programs, marketing, staffing, very important to take advantage of this wealth transfer. Another thing that's always top of mind is where are we at with the market? I have taught for many years with the Lilly School of Philanthropy, and one thing I heard loud and clear over many years of working with the econometricians there and listening to them speak, that the one single most highly correlated factor with charitable giving is the market, is the economy. As economy and stock market goes up, so does charitable giving. It can lag, of course, but it is significant. So, for example, here is a chart from the Lilly School of Philanthropy tracking giving with market trends. And we see that as market goes up, giving goes up. We had a dip, of course, in 2022, but we had a tough economy. We had some market ups and downs. We had high inflation. And when individuals, as we all should know, are scared in the economy, perhaps their giving confidence goes down. So the point is, as plan gift fundraisers, we always must monitor the market, be aware of circumstances, but take full advantage of your marketing and asking and soliciting and proposal giving and visits when market is strong, because that's the good time to ask. Now, of course, as we'll talk a little later, plan gifts are good every time. Any economy, whether it's a good economy, a bad economy, any economy is a good one for deferred giving. Of course, this does not impact current income. So deferred gifts by a bequest in a will of trust, payment or transfer on death of a stock or bank account or real estate, designation of life insurance, retirement plan beneficiary, they're good all the time. I experienced this firsthand during the recession of 2008. It was a very dramatic recession. It wasn't a slow burn. It was a quick fire. And we kicked off a campaign at the organization I was with at the time, a month or so before the collapse. And so we decided, well, we're still going to have to go out there. We've invested all this in campaign planning. So we kind of doubled down on deferred gifts, telling donors that if they needed to reduce their major gift to ask amount, then make up the difference with a deferred gift, or try to give more from a deferred gift to beef up the planned gift goal of the campaign. So the point is, take advantage of strong markets, and when markets go down, really promote heavily the deferred gift ideas. Another key factor from the big picture side of things is building trust. This was brought home most recently by another Lilly School survey of the attitudes of Americans towards philanthropy in the nonprofit sector that was released in 2023, this past year. And I'll make a side note that any Lilly School research that I reference in this presentation is all available at the IU Lilly School website. Be sure to go to the research tab and you can drill down and get PDF summaries and abstracts of all these different research studies that I referenced. But in this one, they were asking key questions such as the public view of philanthropy, the trustworthiness of nonprofits, and how much do they know about the work of nonprofits. Some very interesting results. One is that the Americans public generally do not know a lot about the philanthropic sector. They asked about a variety of things like community foundations, crowdfunding, donor advised funds, and you see low levels of knowledge. It's kind of interesting. So a relatively small percentage seems to drive the engine of a lot of these gifts. So lessons from this is building awareness or understanding. Another lesson learned from this survey is the broad approach that most Americans take with regard to their feelings about philanthropy. That includes the giving of treasures along with time and talents. And I think many of us on this call recognize the value of volunteers, and we've heard in other seminars the importance of especially millennial and younger generations thinking about volunteering as the gateway to their future support of an organization. But giving time, it's a big deal, and as well as giving treasures. So finding volunteer opportunities, it's easier for some organizations than others, I full well realize, but it's something for you to strategically think about, especially in the years ahead. Certainly, we're going to be focusing, as I indicated in the big picture earlier, on the baby boomer and maybe silent generations in terms of gift planning. But as we look even further ahead in the future, it's going to be about the Gen X and millennials. And so the activity of getting them involved now with their volunteer service can pay off big dividends further down the road. So being strategic and creative with volunteer opportunities can help build trust. And don't forget, though, that as you do that, find ways for them maybe to start giving financially as well. You might have to ease them into it, but I wouldn't leave that out of your strategy. You've got to make sure to build into the volunteer system maybe a way for them to consider, at least at small levels, building that loyal annual giving. That's the wellspring from which all big plan gifts flow. Longtime plan giving experts, we all know that longtime loyal donors are number one source for significant plan gifts down the road. Another big finding was the lack of trust. On this slide, we see that nonprofit organizations rank highest in trust, but only 39% of the surveyed said that they completely or very much trust nonprofits even. Second was religious institutions at 31.3, and on down the line to last place being large corporations. This may not shock or surprise all of us in general, but the actual percentages I find of some concern. So one thing I encourage organizations to do, of course, is to think about, well, what can we do to build trust? We know we offer our 990 forms, that's public information, but what other kinds of activities can we do with one thing we did at the Salvation Army is create an annual stewardship report. It's both a thank you to our existing plan gift donors, as well as providing some information, as well as an opportunity to invite questions and feedback. So as we all know from our families and personal relationships, trust is all about communication. And all organizations on this call must be thinking very strategically about how you're communicating, not with prospective donors only, but also existing plan gift donors. As we know through the research of Russell James and others, that just because a person has a plan gift doesn't mean they may not consider changing it or revoking the gift down the road. So you got to keep in close touch and keep the trust and relationship strong. As I often say to my team, since such a great proportion of our plan gifts are revocable bequests and beneficiary designations, every year that a donor, especially retired donors, do not revoke a gift, we'll consider that essentially a new gift. I mean, non-revocation of existing testamentary plans is a big deal, and we need to look at it that way. So we need to invest in stewardship. I mentioned the stewardship report that we're doing. I love the idea of creating stewardship positions, staff members who are devoted to stewarding plan gift donors, recognition societies, making sure all replies to inquiries are followed up on, addresses kept up to date, event planning for small or large groups, all sorts of things, and just answering questions and being of assistance. Very important to steward and maintain and build trust, but be strategic about it. Pick those things that you think might have the most impact on building the trust with your donor base. Lots of challenges looking ahead. Transparency is a big deal. And I think obviously that's built to trust. So building ways and strategies to enhance your transparency through your website, through stewardship reporting, annual reporting with emails or with meetings or events could be very helpful. So the future of philanthropy from this report emphasized using technology to help play a greater role in being as communicative and transparent to a large number of people as possible, being strategic on issues of inclusion and trust building, and connecting with leaders and others. So great report. You can look at it in more depth at your leisure. Another big picture topic I would suggest is the issue of tax benefits. Early in my career, when I first got into plan giving, my mentor once told me when I left law practice to get into plan giving, he warned me, said, Phil, you know, one of these days, Congress is going to take away all those tax benefits and you won't have anything to talk to donors about. Well, I dare say that the tax benefits have not been taken away, and I've spent quite a career in trying to master my knowledge of those tax benefits. But the standard deduction really has been a fascinating occurrence here in the last few years. The standard deduction, as you all know, is now the basic deduction that any taxpayer can claim. And in 2024, it's going to increase by about 5.5% to $14,600 for single tax filers and $29,200 for married filing jointly. So if you claim the standard deduction, you won't itemize. And so only now approximately 14% of our taxpayers annually itemize, and you have to itemize to claim the charitable deduction. So claiming charitable deductions is not as prominently taken advantage of by our donors as perhaps it once was. But it has had some interesting repercussions, such as the issue of bunching gifts. That is, piling together a higher quantity of gifts in a single year to have a dollar amount greater than the standard deduction, so that one may therefore itemize. And the donor advised fund technique is, I'd say, greatly benefiting from the standard deduction. A lot of donors are bunching their gifts in donor advised funds and then granting out over time to fulfill pledges, future building campaigns, endowment building, all sorts of creative techniques. But the tax benefit may all be taken in one year. For example, a high income year, the year of a business sale or other high income triggering event in a life. And well, perfectly fine. The tax code is there to legally, lawfully take advantage of for your benefit. So anyway, I'd say tax benefits is something to keep an eye on. In this regard, we did have proposed, of course, the Charitable Act. It has not been passed, and I hope that it might be, and I hope with all of your help, support for it might bring back this universal deduction. We had it back in the 80s. We had it again a year or so ago. And this is not a itemizable deduction. It's a deduction available to any taxpayer, regardless of income level, regardless of whether one itemizes. And this is our citations for the current versions of the Charitable Act, and I do encourage its consideration. So that's kind of it for some big picture issues that I encourage you to think about. I'd like to now focus a minute on building relationships as we look to next year and the years beyond. It's all about relationships. If we have to summarize plan giving and fundraising in one word, it would be relationship, right? So you have to consider the potential of all relationships. I find this very important. As we all know from the Giving USA reports, and these are the summary from the last report, that individuals drive charitable giving. 64% of the pie individuals, another 9% individuals by bequests, and then the foundations, 21%, a vast majority of that, family foundations or individuals calling the shots inside foundations. So it's all about individuals. And we all have wonderful stories about donors. Meet Osolo McCarty, now passed. Ms. McCarty worked in the washing and janitorial service at the University of Mississippi. She was very philanthropically motivated, literally saved dimes and pennies over years and years, and would put money, very frugal, in her bank account. And one day her bank trust officer said, you know, Ms. McCarty, you really have a lot of money in your savings account. Maybe we ought to think about investing or doing something with it. And she mentioned great interest in philanthropic planning. And long story short, ended up establishing a 6-figure charitable remainder trust that she earned extra retirement income from. And the beneficiary of it was wonderful scholarships for students. Just a marvelous story of what one person can do with a huge love and heart and desire to help others. Also meet Richard Leroy Walter. This is an individual who was homeless, who had struck up a friendship with a Phoenix mission, and ended up at his passing having about a $4 million estate, leaving a large gift to that Catholic mission, as well as to his alma maters, Purdue and Ball State. I used to work at Ball State. That's how I know this story. You can actually listen to a podcast of this story if you Google Richard Leroy Walter at NPR, and it's only about a 3-minute audio, but it's a great story. But again, these are faces of philanthropy, of folks that you might not normally think of as a significant plan gift donor, yet amazingly, by the establishment of relationships, you can open the door to wonderful opportunity. You know, for example, I was just talking to a member of my team this morning, who mentioned that one of their big sources of finding out about plan gifts or leading to plan gifts are thank you calls. Thank you calls for individuals who've made a recent gift, who have volunteered, or any one of a number of reasons that we find it important to call and say thank you to people. So building a relationship out of saying thanks and showing appreciation is a good way to go. But it's all about the relationship, regardless of what the surface or what the individual may appear to be. You never know about that millionaire next door or that philanthropic heart where you might least expect it. Another aspect of relationships is thinking about partnering with entrepreneurs. In my career, entrepreneurs, of course, are often individuals who've amassed a certain degree of wealth, of course, by starting a business and being successful with a business. They also like to plan. They typically love to save taxes. And now they might be micromanaging. They obviously sometimes like to tell you what to do and want to take risks that you may not be comfortable with. So be aware of prearranged sale rules and other maybe issues of control that you might bump into with entrepreneurs. But my, oh my, entrepreneurs have been busy in the social service arena. You know, many states have passed a version of what's now called a benefit corporation. This is a for-profit corporation, but by virtue of statute, it's also devoted to public good as well. And what this means is that the shareholders can still earn a profit, which makes it different from a nonprofit corporation. But the standard of care for the directors of the corporation need not be exclusively maximizing shareholder value. So benefit corporations are a hybrid, unique kind of for-profit entity that does allow for profit sharing among shareholders, but also sets a different standard of expectation of the directors, that they don't have to maximize shareholder value. Why? Because they're serving some other greater cause. You know, Ben & Jerry's ice cream is a good example of a benefit corporation. Many of these kinds of entities get a seal of approval called B Corp certification. You can Google that, but these B Corp certifications are good labels for these kinds of entities to attract angel investors, individuals with pools of money who like to invest, but want to invest with a social cause in mind. Other examples of this, if entrepreneurs involved in the social service arena, is Paul Newman's own dressing. They got a separate and new private foundation ruling to provide an exception to the excess business holding rule of private foundations, so that 100% of the business can be owned by the private foundation, so long as 100% of the revenue flows out to charities after expenses and costs are paid, of course. And then more recently, Patagonia got a lot of press when the founder of Patagonia established a 501c4, funding it with a large quantity of non-voting stock with a separate trust controlling the corporation. This wasn't about an income tax deduction, but rather 501c4 lobbying and political campaign activity was kind of this individual's interest. But the point of it here is that thinking about and partnering sometimes with entrepreneurs, you could together use some of these enterprises for, education of students, or for providing services to the people in need that you're serving. So you could come alongside your organization, a benefit corporation, a B Corp, and together serve a population that interests an entrepreneur. And that might leverage gifts to your organization from the same entrepreneur. Other issues relative to investment and entrepreneurs are mission-related investments. This is your organization taking your money and investing your portfolio, whether it's endowment or not endowment, in either socially responsible screening or ESG or other kinds of screening, either in or out of certain investments. A more proactive type is program-related investments. This is where you're basically granting your charity organizations to other activities, some of which might also involve entrepreneurs. Here's a list of examples of approved program-related investments, like number 4, investments in businesses in low-income areas under a plan to improve the economy of the area, providing employment, training, and so forth. So again, this is an example of perhaps a charity that is part of its mission is to serve the poor and needy in an area, might do program-related investment with some of your either gifts or grants from your organization, but also partner with other entrepreneurs in serving these kinds of needs. Just think outside the box sometimes when you deal with entrepreneurs. Another new study by the Lilly School is one that focused on affluent donors. Affluent donors was defined as individuals with an annual income of $200,000 or above, or net assets of $1 million or above. 85% of them made gifts in 2022, and average amount given $34,000, almost $35,000, about 13 and a half times greater than the general average. This has been a long time study by the Lilly School in partnership with Bank of America. Half of these affluent households give to issues they care most about. 70% give to organizations that relate to their personal values or beliefs. So your relationship with these affluent donors is very important, because the way they look at their philanthropy is based on their personal values and beliefs, very personally driven. And 78% giving is focused locally. Now, locally has and can be broadly defined, perhaps, for some people, either within a city, a state, or even the country. But take a closer look at the study online and you can learn more. We don't have time today. But another attribute of affluent giving is the use of plan giving vehicles. 22% of this survey said they're currently using a giving vehicle, but 84% said they would use one within the next 3 years. My friends, that's 2024, 2025, 2026. So with the will bequest being number 1, but other kinds of plan giving opportunities there as well. This is a crowd that I think is well suited, obviously, for plan giving discussions, talking about the kinds of vehicles that we are expert in. So take a look at that study and be strategic in zeroing in on affluent households. The third broad area I'd like to talk about today is dealing with donor intent. There one thing I like to often say about the baby boomer generation is, as I distinguish it from my parents, the World War II generation, I often describe the World War II generation mantra for philanthropy as, I love you, I trust you, here's my unrestricted gift. These are individuals who grew up in the Depression, they fought through World War II together, they built their homes, careers, put kids through college, and so they weren't as perhaps always as active as a generation in philanthropy as the baby boomers are. And I would suggest their mantra is, I love you, but I'm just not sure I trust you 100%. The boomers are, a lot of them, they were the rebel rousers in college and questioning authority, questioning institutions. I don't have time to go in. I put on this slide a number of court cases and other matters involving scenarios where donors felt like perhaps trust was violated or provided evidence of lack of a trustful fulfillment by an organization. Very complicated cases. Don't have time for it, but feel free to look them up and Google and read more as you can. But consequently, the boomers quite often ask strategic questions. You need to have answers to their questions. And if you don't answer those questions adequately, you may not get the kind of gift that you might otherwise. So here's a list of key questions. What differences that these baby boomer donors especially might be thinking of. What differences do I hope my gift will make? Who do I know and trust? Again, trust, a big issue. Will there be fees? What are they? What happens if my intent is not honored? Do you do a gift agreement? How can I be confident that my intent will be fulfilled? So just some important questions to think about. So implement best practices would be a recommendation in the years ahead to safeguard donor intent, to assure donors that you will honor their wishes. Do an inventory of your existing gift documentation, copies of will bequest, gift agreements, endowment agreements. What are your policies and procedures for gift acceptance? How is negotiation handled? Do you have a naming recognition policy? What is your policy for documentation? Thirdly, again, stewarding these donors. We talked about stewardship earlier, very important. And then, can you make amendments pursuant to applicable state law? Here are some good resources. The Philanthropy Roundtable has put together some how-to guides for creating intentional thoughts by donors around mission statements for their giving or safeguarding their gifts. You might take a look at this collection of great resources at the website on this slide. So quite often, especially if you're an organization that has endowments, and one thing you realize with endowments and larger gifts sometimes is that endowment is meant to last forever, and forever is a very long time. And what can change over the course of forever is unlimited. I mean, everything kind of changes. So I think of Buzz Lightyear and his mantra of to infinity and beyond when I think of endowments. But I also realize that with this concept of infinity can be trouble because things can and do change. So all I want to share here is that 49 of the 50 states have passed a version of the Uniform Prudent Management of Institutional Funds Act. Within that state statute are 3 different protocols for making a change, actually 4, that allow for a change. For example, if a donor is still alive and you had a signed gift agreement, an endowment agreement, and the like, with the consent of the donor and your board of directors, you can edit or make a change to the terms of any gift. In cases where the donor is dead or perhaps disagreeing, you can go to court and request a court order with notice to the Attorney General. I've done a number of these kinds of actions, and typically I like to get a buy-in from the Attorney General, a review of the petition before I file it with the court, so that I address ahead of time any concerns the Attorney General may have. And in most states, if the fund is below a certain dollar threshold, like $200,000 or $100,000, and has been around for a number of years, usually about 20 years, a court order is not necessary, simply notice to the Attorney General. And these kind of changes are changes to purpose or changes to mechanics. So either the purpose might be, times may have changed, and that original purpose, like a gift set up for young women studying to be secretaries 50 years ago, not maybe relevant today. So we need a change in purpose. Or maybe a donor set up an endowment with specifying a spending rate of $100 a year. Well, $100 a year doesn't buy anything anymore. And if the fund has gotten really big, you need to change. That's a mechanical change. So changes to purpose, changes to mechanic can all be accomplished through this kind of variance. Excuse my cold. I'd like to end before we open it to questions and answers with the fourth broad area, discussing some opportunities for powerful philanthropy in 2024 and beyond. First and foremost, I hope everybody on this call has been introduced to the idea of gift blending and blending the power of the pyramid. As we all know, fundraising is in a sense a pyramid scheme in a good way. We try very hard to get first-time donors into our fold, and then through good work, we get them to repeat and hopefully become loyal donors. And then sometimes from this pool of loyal donors over time come major gifts. Of course, many major gifts come from outside the pyramid as well. They don't all bubble up from loyal donors. But at the top of the pyramid, of course, are plan gift donors. And there's several secrets to this pyramid. Number one is there's a high correlation statistically between the loyal annual giving crowd near the bottom of the pyramid and the plan giving crowd at the top. So obviously, you've got to track your donors, identify who are the longtime loyal donors, and be sure that they receive information about and you appeal to them to consider a planned gift from their estate. In addition, though, you don't forget about major gift donors, because quite often they are invested in your organization. Now, many campaigns today, whether it's comprehensive campaigns, capital campaigns, programs, specific program campaigns, will have blended goals, a current outright cash goal and a deferred gift plan goal. And so gifts or requests of donors can include a mix of a cash gift, a pledge of a cash gift to help satisfy the cash goal, and then supplementing the cash gift with a planned gift down the road to help with programs or endowments for that purpose in the future. This takes a lot of strategy. Now, sometimes you may not want to ask for the planned gift at the same time as the cash gift. The planned gift ask can be a follow-up subsequent ask, depending upon what the donor says relative to the cash gift. But if the donor said yes to a cash gift ask, you can always go back later, ask them to supplement with a planned gift that doesn't cost them any more money now. If the donor says no to a cash gift, well, you can come back with a request for a planned gift because it doesn't cost them any money now. Or if the donor says some value, you compromise at some value less than the asked for amount, maybe a planned gift can supplement or make up the difference. But the point is, we have to think strategically and not in silos between planned and major gifts. We've got to integrate to be as effective as possible. I'd say another powerful technique moving forward, obviously, is maximizing donor advised funds. As we all know, billions of dollars in DAF, this bunching idea to itemize and then grant later, very popular. Amazing levels of grant making during COVID, lots of great research showing grant making out of donor advised funds much greater than the 5% required of private foundations. Also, law now permits donor advised funds to satisfy charitable pledges. Happy to share that law and talk about it to anybody who has a question about it. And furthermore, if you're getting grants of donor advised from donors, then as long as they're not anonymous, I recognize that some are anonymous, but that's a minority. Make note of those people, and you can go back to them and suggest that they could name your charity for the residual of the DAF when the donor advising ends. Most sponsoring organizations ask donors for these kinds of recommendations, and those are revocable. If a donor requests a sponsoring organization to add your organization in for the residual or replace another with you, I dare say that would likely be approved by the sponsor, most likely, depending upon circumstances. I understand there are a lot of nuances here. But the point is, oh, think of the residual of a DAF as another kind of deferred planned gift. It's not just the money you get now from the DAF, but money that might be there later. Because look, we never know when we're going to be our days are done, and so the fact is the DAF may not be empty when the donor dies. So you've got to account for the residual. We did have the ACE Act that was talked about for a couple of years, but it's not received support from the charitable community. It was an attempt to force out payments from DAFs by setting a specific spend rate. It's not been supported primarily because the grant making from DAFs has been extraordinarily high and not problematic. There's not a problem, broad-based problem of stockpiling. So it's kind of waned, I would say. We do have some pending new proposed DAF regulations that have been released here in the last couple of weeks, and it's got some problems in it. And I'm working behind the scenes to send comments because one proposed regulation is to define investment advisors as donor advisors. That could have troubling repercussion for many community foundations. Another troubling aspect is a designated fund for a single entity. If the donor who set up the designated fund is also on the board of the designated charity, then that would be deemed a DAF, which would be very problematic, especially for rural community foundations where everybody's on a board now and again, and it would be very problematic, and would make the designated fund disqualified for IRA charitable rollover gifts, by the way. And then there's an exception in this regs for committee advised scholarships, but only for 501c4s. And there's no reason not to expand that to others. So there are some improvements that could be made to those proposed regulations. Obviously, this has been talked about a lot, but powerful philanthropy through non-cash gifts. One of my very first slide, 80% of the wealth of the boomers, non-cash assets. You've got to be facile, ready, and willing to consider non-cash gifts. You don't have to take every non-cash gift that comes down the road, but at least have the conversation. Get independent counsel to help you think through and not just an automatic no. Again, as wealth goes up, so does the type and allocation of your non-cash assets. So the top 20% has a lot, a fourth in real estate, about a fourth in retirement pension funds, financial securities, about 20%, and so forth. But for the ultra wealthy top 1%, you can see that business equity is a half or more of their wealth. So now privately held stock becomes a big deal. Still a lot of real estate, financial investments, retirement plan, and the like. But you've got to be open to the non-cash gift conversation. Publicly traded stock, privately held stock, real estate, especially farmland, gifts of grain for those in rural areas. You've got to be knowledgeable of the IRS forms 8283 and 8282, and the gift receipt publication 1771, and publication 561 determining the value of donated property. Be aware of these rules that are here in these publications and forms, and promote non-cash gifts. I'd be remiss if I didn't say consider a charitable gift annuity program if you don't have one. And if you do have a gift annuity program, the rates are increasing as of January 1. The actual rates themselves won't appear till later this month, if not till the end of the month, depending upon whether you're a member or not a member. If you're a member, you'll find out December 18th. But the website here is where you'll go to see what the new rates are. But one trend we're noticing with gift annuities is an increasing use of gift annuities by donating non-cash gifts like stock and real estate. I'm working on my third large farmland gift for a gift annuity right now, and this is the third in about a 2-year time frame, a little less. So my point is that a lot of the boomers and others are thinking of larger gift annuities in the $100,000 plus range with non-cash assets, whereas the World War II generation generally thought of cash gifts at smaller dollar amounts like $10,000, $25,000, and repeating, let's say. So the scene has changed with regard to gift annuities a bit, and I encourage you to take a look at them. Of course, retirement plans. You've really got to focus on on donations from retirement plans. Of course, the beneficiary designation at death, it's a big deal. Obviously, a gift from a retirement plan is the most tax-wise gift to make at death. The heirs escape the income tax liability. Leave the assets to the kids because they'll get a step up in basis and will escape the capital gains tax. Leave the retirement plan to charity and the heirs escape the income tax liability. So retirement plan to charity at death, assets to the kids. It's a wonderful technique to promote your donors. Now, beware, we've got a problem nationally with the slow delivery of these retirement plan beneficiary gifts. The RIFT project, Johnny Hayes and others have undertaken for our benefit is very important. Go to this website, take a look at it, try to get engaged because there is an historic problem in getting the money out of the retirement plans after the death of the donor as readily as we need that money. So that's an ongoing conversation beyond this, but I want to make you aware of it. Another planning, of course, technique with retirement plans is the stretch opportunity. You know, the Secure Act capped the payments to kids at 10 years, and lots of moms and dads, grandmas, grandpas want more than 10 years. So that testamentary gift for a retirement plan to a share remainder trust or a gift annuity, very popular. Stretching out those payments because, you know, moms and dads often don't trust Johnny or Susie in their 30s, 40s, even 50s, and they want them to be assured of getting an ongoing income stream. So testamentary designations with a retirement plan for a CGA or a CRT. Of course, we love the IRA charitable rollover, also known as the qualified charitable distribution. The new, the law last year passed allows for an inflation adjustment. So for 2024, the IRA rollover QCD amount is going to be $105,000. Remember, these are individually owned by husband and wife. So from each IRA of husband or spouses, each spouse can give up to $105,000 in 2024. Of course, we have also the QCD for a charitable gift annuity or charitable remainder trust. This is a one-time use. You got to use it. But the cap has also been adjusted for inflation, and it'll be at $53,000 in 2024. It's going to go up a little bit every year after 2024. This is a technique attractive for gift annuities. I've done several of these, but not charitable remainder trust. The $50,000, now $53,000 cap is too small, in my opinion, for charitable remainder trust. We could lobby, all of us, for improvements to this law to allow for a multi-year opportunity rather than a one-time $50,000 within 1 year cap, and a higher annual maximum. Instead of 50, why not 100,000? Make it more attractive for CRTs. Those are just two ideas to make this law even more attractive. My friends, as I started this presentation, my overall theme for you is the time is now. The time is now for plan giving. Invest in plan giving. And in 2024 and beyond, I think you'll see wonderful results. As my friend Bob Dylan says, as the present now will later be past, the order is rapidly fading, and the first one now will later be last, for the times they are changing. And if you want your organization to be first in line down the road, you've got to change with these changing times and be ready for the future. Thank you so much for your time and attention. We can take a few questions.
Thank you so much, Phil. We do have a lot of questions exploded about the DAFs. People want to know about the DAFs. So before I ask you that, real quick, I want to let people know that we do want your input for our webinar series next year, as Jeremy said in the beginning. So on the post-webinar survey that will pop up when you leave, you can just put that in the general comments at the end. There's an open-ended form for you to put any comments. You can put those in there. Great, thank you. Okay, so Phil, DAFs, we just want to make sure, first of all, did you say that DAFs can satisfy charitable pledges?
Yeah, IRS notice 2017-73, 2017-73. You can Google it, and it actually, what's fascinating about it, it's a notice which normally you think of a notice as just saying, here's our notice. But in that notice, it said taxpayers can rely on the provision in the notice that pledges can be fulfilled. So and I'm on an American Bar Association committee and met with Treasury last year and raised this question. I said many DAF sponsoring organizations are still nervous about fulfilling when they find out about a pledge. And the response I got was, well, we said they could in the notice. What more do you want us to say? Now, so it's very clear in IRS Notice 2017-73, and I've heard it spoken to me as plainly as that. I don't know what more to say. Now, it's wonky. The problem with it is when the sponsoring organization makes the payment, the law says they cannot reference that it is a pledge payment. So the charity, the recipient, can have a pledge on the books. They get the grant, but the grant cannot reference the pledge, but they can write down the pledge and keep a current pledge on their books. So what's got to happen is the donor is going to have to communicate to the charity, oh, my DAF grant is for a pledge. Or when charity gets the DAF grant, realize it's from Bob, see that Bob has a pledge, you call Bob and say, Bob, is this to pay down your pledge? If he says yes, you can do it. So there it is. I can talk endlessly about it with more historic background, but that's the nub of it.
Okay. I think you covered most of these. Is it something that changed recently, or has that been there the whole time?
Well, the notice 2017, this is 2017, so it's been out there a while. And it had a period of comments and so forth, but it's been slow because it was so astonishingly different than what especially community foundation field had been thinking. The former worry was that a DAF is not owned by the donor. So how can a donor use an asset pool like a DAF that they don't own anymore to satisfy a pledge that's binding to the donor, not to the sponsoring organization? Totally understand that. But think about it a minute. We're able to send a missile to deflect the trajectory of an asteroid in space from hitting Earth, and yet we could not put donor advised funds and donor pledging together in the United States of America. How do charities raise money? Pledging. How are billions of dollars of gifts given? Through donor advised funds. If we can't put these two together, it's a serious disconnect in philanthropy, in my opinion. And so what this law has said is you can do it. You got a DAF, you can satisfy a pledge. It's just when the sponsoring organization sends the DAF grant, they can't reference the pledge in the letter. All right, fine. Okay. If that's all you have to do to make it happen, that's okay. But there are sponsoring organizations who are still reluctant to do it, but many are getting on board with it. And I talk about this all the time. But again, you can Google IRS Notice 2017-73, read it for yourself.
Great, thanks. And I think you covered mostly what people were asking. And I think if they have further questions about that, they can reach out to you through the email that's on the screen.
Sure.
So Jeremy,
again,
did you have one?
I have one here too. Yeah, thanks, Jen. Great job, Phil, especially considering you're fighting a head cold. We really appreciate you jumping in and helping us out today. A good question here about resources. What is your go-to source to track or to monitor pending legislation affecting plan giving? You mentioned ACGA, you mentioned Charitable Gift Planners Association. Where do you go, Phil?
Well, you've got to understand I'm online all the time. So I sign. You can get email blasts. You can go to the IRS tax exempt website, IRS tax exempt, and sign up for an emails. And that sometimes has things. It's different sources. So I get as many multiple sources. It's not maybe one single source. So CGP, National Association of Gift Planners, American Council on Gift Duties, they're good sources. The independent sector, Council on Foundations, AFP if you're or AHP, depending upon what organization you're in. Of course, you can track bills at congress.gov. If you know the bill number, either the Senate or House number, you can track the bill, and you can sign up for email blasts based on those bills. So if you want to track a bill and have emails sent to you, go to congress.gov, get in there, and sign up for email blasts to follow bills. Those would be the main things I do. I'm on a lot of email lists asking for these kinds of notices. And then I proactively every so often go out and look myself at congress.gov and or asking colleagues. That's what I do.
Wonderful. Jen, I got
Yeah.
another one here, kind of just a broader question, kind of jumped on the first part of the webinar here. Do you have a good reference for how to value plan gifts for accounting purposes? Was the question, Phil?
Well, right. What I'm old, so forgive this a little longer answer, but the way I like to look at this is beauty is in the eye of the beholder. So how you regard a planned gift depends upon your perspective, right? So if you're an accountant and you want to value planned gifts, you got to follow generally for most nonprofits, Financial Accounting Standards Board standards, FASB. Now the FASB standards talk about present value for the split interest gifts, we don't have time to go into great detail, but FASB for the accountants. Now there's GASB for the government group and so forth, but FASB is the main one. Now, look, if you're talking about measuring for either metrics for individual staff performance or goal setting for an annual goal or a campaign goal, there are two different sets of standards by the National Association of Charitable Gift Planners. There's and go to the Google, go to the NACGP website and go to their standards, and you'll find them right there. And they have standards on metrics for gift planners. This is performance metrics, goal setting standards. Those are two separate things. They also have interesting standards on financial valuation of gifts. How do you value like the interest in a charitable main trust? That's beyond the present value thing, as well as life insurance stuff. So there's lots of good stuff there. Now there's another one is tax rules. Now the way the IRS values is going to be driven by federal tax law. So my friends, Crescendo and PG Calc and other vendors have wonderful calculation tools. The law is very clear on what formula you use, and that's pretty generally black and white with a lot of nuances, of course. So it's all about perspective and what you're counting and what you're counting it for what purpose, whether it's accounting, metrics, goal setting, tax deduction of the donor, different go-to resources.
Great.
Wonderful.
Thank you, Phil. We are out of time. So I just wanted to say there was a couple additional questions in there. If you would like to reach out to Phil personally, he invites that. His personal address is on the screen, pmpurcell@outlook.com. You can also reach out to Jeremy or myself. Emails are on the screen. And then one last note is that we recorded the webinar today, and we'll have that along with the handouts available for you tomorrow on stelter.com/webinars. I will send out a personal email to the whole group to let you know when it's there. So you can look for that. And that's it for us for today. And like Jeremy said, this is the last webinar we have this year. So thank you everyone for joining us throughout the year. We've had a wonderful roster of presenters and couldn't end with a more respected voice today with Phil Purcell. Thank you so much, Phil.
Thank
For your
you.
time. Thanks. And
Happy
thanks for joining us,
holidays.
Jeremy.
Happy holidays. Happy New Year, everyone.
Take care.
Happy holidays. We'll see y'all next year. Bye-bye.